Have you ever wondered what makes the world of finance spin? It's a thought that might have crossed your mind at least once. We live in a world governed by financial principles, where the exchange of goods, services, and currencies form the lifeblood of our global economy. Yet, amidst all these complexities, what is the one factor that truly drives the gears of this vast financial machine? Could it be the intricate web of international trade? Or perhaps the ever-changing trends in the global economy? Or is it something else entirely? Something more elusive and cryptic? Could it be the mysterious, often unpredictable entity known as the stock market? A place where fortunes are made and lost in the blink of an eye. A realm where numbers on a screen can determine the fate of nations. The answer is a resounding yes. The first step in understanding the stock market is to comprehend what exactly a stock is. To visualize this, imagine yourself in an age-old bustling bazaar. Instead of a simple exchange of fruits, vegetables, or traditional crafts, this market deals in a different type of commodity. This merchandise isn't tangible, but represents ownership fractions of various companies. These fractions, known as shares or stocks, are traded amongst buyers and sellers in the market. This kind of trading holds meaning. When you participate in this exchange and purchase a stock, you're not just buying a commodity. You're investing in a piece of a company, holding a stake in its success or failure. Understanding why companies sell stocks is the second step. Now let's consider an example. Imagine a small yet enthusiastic enterprise. This organization has vast dreams of expansion but lacks sufficient capital. With growth as their primary objective, they are short on financial resources. Thus, they're pushed to make a strategic move. They decide to sell stocks, dividing their ownership. This is the method by which they raise the funds they need. They offer the public a chance to hold a stake in their establishment. This crucial process is known as an initial public offering. Or, step 3 introduces you, the investor. An investor's role within the stock market is pivotal. Essentially, you're placing your hard-earned money into a company by purchasing their stocks. These stocks represent a fraction of the company, a minute piece in the larger puzzle. Your motivation is the belief that the company you've invested in will continue to expand and attain success. If your prediction is correct, the value of your shares will also augment. This growth provides an opportunity for you to sell these stocks at a higher price, turning a profit. Alternatively, some companies distribute dividends, which are slices of their profits, directly to their shareholders. The cycle then repeats, creating a dynamic and ever-changing market landscape. Understanding the stock exchange is the fourth step. It's a crucial stage to grasp if you're interested in mastering the art of investing. Essentially, it's an electronic or virtual market where buyers and sellers come together to trade shares. This digital platform serves as a bridge connecting investors from all over the world. It is the beating heart of the financial markets, a nexus of trade and commerce. It is here, in this bustling world of number and figures, that fortunes are made and lost. Some of the most well-known exchanges that command global attention are the New York Stock Exchange, the Nasdaq, the Tokyo Stock Exchange, and the London Stock Exchange, among others. These exchanges, particularly the New York Stock Exchange and Nasdaq, are the powerhouses of global economic activity. Step 5 introduces us to the pivotal role of supply and demand in the stock market, a core principle that dictates the price of a stock. It's crucial to remember that the price of a stock isn't static. It isn't a fixed number clinging to immobility. It's a dynamic figure, a floating entity that changes, fluctuates, and oscillates throughout the trading day, responding to the invisible and often unpredictable forces of it. Moves based on the demand and supply, the desire of people to own a piece of a company or to let go of it. If the number of people wanting to buy a stock outweighs wishing to sell it, the price sees an upward trend. The opposite scenario results in a downward trend. If more people want to sell a stock than buy it, the price goes down. The final step, which is step 6, focuses on comprehending the complexities of the stock market. Remember, this journey is not a short race, it's more akin to a marathon that tests your endurance and determination. The stock market is a labyrinth, a world of its own, teeming with endless possibilities and uncertainties. It requires far more than just a cursory understanding of finance and investment principles. It demands patience, an attribute that, when mastered, can yield unimaginable returns. It necessitates thorough research, an in-depth analysis of trends, and an assessment of risk-to-reward ratios. Sometimes it might even necessitate a stroke of luck. This step is not just about making a quick profit, it's about mastering the rhythm of the market, understanding its ebbs and flows. All it takes is one good decision to set off a chain reaction of profitable outcomes. But always remember, the stock market, like any other investment, comes with its own set of risks. But then again, no risk, no reward, right? And sometimes a bit of luck. To summarize, stocks are essentially company fragments, sold to raise funds. As investors, we engage in the stock trade, experiencing the virtual marketplace known as the stock exchange, an arena of supply and demand dynamics. Remember, mastering the stock market is a long-term game. It might seem complex initially, but it's far from impenetrable. Armed with patience, diligence, and bravery, you can decipher its patterns. Thus, whenever stock market hits the headlines, you'll comprehend the scenario.